Welcome to our exciting exploration of A Random Walk Down Wall Street, the time-tested strategy for successful investing 12th edition, by the esteemed Burton G. Malkiel. We're thrilled to have you join us as we delve into the timeless strategies that can help you navigate the world of investing. If you enjoy our presentation, don't forget to give us a thumbs up and subscribe for more insightful content. Now let's dive into the wisdom of this classic book. In this introduction, we explore the key themes of Chapter 1, titled Firm Foundations and Castles in the Air. The chapter sets the stage for understanding the complexities of finance and reassures individual investors that they can compete with professionals. It emphasizes the importance of steady investing, especially during market downturns, and introduces the various investment strategies that will be discussed throughout the book. Additionally, it highlights the distinction between investing and speculating, as well as the critical role inflation plays in shaping investment decisions. This foundation is essential for navigating the investment landscape. This frame delves into the two primary investment theories discussed in Chapter 1, the firm foundation theory and the castle in the air theory. The firm foundation theory posits that every investment has an intrinsic value that can be determined through analysis, while the castle in the air theory focuses on the psychological aspects of market behavior. The chapter also provides historical examples of market crazes, illustrating the unpredictability of stock prices in the short term. Understanding these theories is crucial for making informed investment decisions. The author's personal experiences further enrich the discussion, offering valuable insights into the investment world. In this introduction, we explore the key themes of Chapter 2, titled The Madness of Crowds. The chapter emphasizes the dangers of speculation, particularly in October, as noted by Mark Twain. It highlights how historical booms have led to reckless behavior among market participants who often ignore fundamental values in favor of speculative thrills. The psychology of speculation is described as irrational, with historical examples such as the tulip bulb craze and the South Sea bubble, illustrating the consequences of collective stupidity in crowds. This sets the stage for a deeper understanding of market psychology. This frame delves into two significant historical examples of speculative bubbles, the tulip bulb craze and the South Sea bubble. The tulip craze in 17th century Holland saw prices skyrocket as demand for rare varieties surged, leading people to barter their possessions for bulbs. Similarly, the South Sea Company attracted investors with promises of immense riches despite lacking a solid business foundation. Both cases illustrate how the allure of quick profits can lead to irrational behavior and ultimately catastrophic financial losses. These examples serve as cautionary tales about the dangers of speculation and the psychology of crowds. In this frame, we introduce the chapter's main theme, which revolves around the speculative bubbles that occurred from the 1960s to the 1990s. The madness of crowds is highlighted, emphasizing how collective irrationality can lead to significant financial consequences. The dominance of professional portfolio managers in trading volumes is noted, raising questions about their role in perpetuating speculative behavior. Despite their expertise, these institutions participated in speculative movements, often driven by the expectation of selling to less informed investors. This sets the stage for a deeper exploration of the historical context and implications of these bubbles. This frame delves into the specifics of the 1960s speculative environment, particularly focusing on the soaring interest in growth stocks and the emergence of conglomerates. The chapter illustrates how companies like IBM and Texas Instruments were valued at unsustainable price-earnings ratios, leading to a speculative frenzy. The Tronics boom is highlighted as a period marked by numerous fraudulent stock offerings, showcasing the risks investors faced. The concept of synergism in conglomerates is discussed, where mergers created an illusion of growth without genuine value. Ultimately, the collapse of these speculative trends serves as a cautionary tale about market vulnerabilities and the dangers of unchecked speculation. This frame introduces the chapter's focus on the significant economic bubbles that occurred in the early 2000s. It highlights the staggering loss of market value during the Internet bubble, which was unprecedented in scale. The chapter also discusses the U.S. real estate bubble and its global repercussions, emphasizing the interconnectedness of economies. Additionally, it touches on the rise of Bitcoin and its speculative nature, drawing parallels to historical bubbles like the tulip craze. The frame sets the stage for a deeper exploration of the factors that contributed to these economic phenomena. This frame delves into the specifics of the internet bubble, explaining how it was driven by excitement around new technology and business models. The concept of positive feedback loops is introduced, illustrating how rising stock prices attracted more investors, creating a cycle of speculation. The miscalculations of major financial firms, such as Goldman Sachs, are highlighted, showcasing the disconnect between investor sentiment and actual market risks. The frame also notes the dramatic rise of the Nasdaq index and the trend of companies rebranding themselves to capitalize on the internet craze. Ultimately, it underscores the devastating impact of the bubble's burst on investors and the market as a whole. In this frame, we introduce Chapter 5, which delves into the world of technical and fundamental analysis in stock trading. The chapter emphasizes the vast scale of trading activities and the importance of accurately estimating the value of stocks. It highlights the two primary methods of analysis: technical analysis, which focuses on price trends and patterns, and fundamental analysis, which seeks to determine a stock's intrinsic value based on company performance and market conditions. The frame sets the stage for a deeper exploration of these methodologies and their implications for investors. This frame discusses the key differences between technical and fundamental analysis. Technical analysis is primarily concerned with interpreting stock price charts and trends, often disregarding the underlying business fundamentals. Chartists believe that market psychology plays a significant role in price movements. In contrast, fundamental analysis focuses on evaluating a company's financial health and intrinsic value, relying on logical assessments of earnings, dividends, and growth potential. While both methods have their merits, they also come with inherent risks and limitations, making it essential for investors to understand their respective approaches to make informed decisions. In this frame, we introduce the key themes of Chapter 6, which discusses the principles of technical analysis and its relationship with the random walk theory. The chapter emphasizes that technical analysts focus on stock price movements rather than fundamentals like earnings or dividends. It highlights the common phrases used in technical analysis, which reflect a mindset of trading based on perceived patterns. However, the chapter also points out the irony that many technicians do not achieve financial success, raising questions about the effectiveness of their methods. Ultimately, the chapter suggests that stock market behavior resembles a random walk, where past price patterns do not provide reliable predictions for future movements. This frame delves into the challenges faced by technical analysis as outlined in Chapter 6. It emphasizes that many technical strategies lack empirical support and often do not outperform a simple buy-and-hold strategy. The random walk theory is introduced as a concept that suggests stock prices are largely unpredictable, which undermines the foundation of technical analysis. Additionally, the frame discusses how technicians may perceive patterns in stock movements that are merely illusions. The impact of transaction costs is also highlighted, as these can significantly reduce any potential profits from frequent trading. Finally, the frame cautions that just because a strategy has worked in the past does not mean it will continue to do so in the future. In this frame, we introduce the chapter titled, "How Good is Fundamental Analysis? The Efficiency." The evolution of fundamental analysis is highlighted, showcasing how analysts transition from mere data entry to becoming influential figures in investment decisions. The rise of equity research stars on Wall Street is noted, emphasizing the shift in the industry. The frame also presents the ongoing debate regarding the effectiveness of fundamental analysis, contrasting the confidence of Wall Street professionals with the skepticism of the academic community. This sets the stage for a deeper exploration of the topic in the following slides. This frame delves into the challenges faced in fundamental analysis. Analysts often find it difficult to accurately forecast future earnings, as past performance does not reliably predict future outcomes. The influence of random events, such as market fluctuations and unexpected corporate changes, complicates predictions further. Additionally, The use of creative accounting practices can obscure a company's true financial health, making it harder for analysts to provide accurate assessments. Conflicts of interest within firms can also skew recommendations, leading to biased advice. Finally, the efficient market hypothesis raises questions about the overall validity of fundamental analysis, suggesting that it may not provide a significant advantage in investment decisions. In this introduction, we set the stage for discussing modern portfolio theory (MPT), which is a crucial concept in finance. The chapter emphasizes the theoretical foundations that underpin stock valuation and the importance of understanding risk in investment decisions. It highlights how the dispersion of returns serves as a key measure of risk, and it also touches upon the historical performance of different asset classes. Finally, the introduction hints at the significance of diversification as a strategy to mitigate risk, which will be explored in more detail in the following slides. This slide delves into the concept of risk and its implications for investors. It begins with the efficient market hypothesis, which suggests that stock prices reflect all available information, making it difficult to predict market movements. The definition of risk is clarified, emphasizing the potential for loss. The slide introduces variance and standard deviation as key measures of risk, supported by historical data that indicates a correlation between higher risk and higher returns. Furthermore, it discusses how diversification can mitigate risk, particularly through negative covariance, and highlights the benefits of international diversification in enhancing portfolio stability. In this introduction, we explore the chapter titled Reaping Reward by Increasing Risk. The chapter emphasizes the relationship between risk and reward in finance, highlighting the importance of analytical tools for measuring risk. It introduces modern portfolio theory, which refines our understanding of risk, particularly through diversification. While diversification can mitigate some risk, it cannot eliminate it entirely. The capital asset pricing model (CAPM) is presented as a key framework for understanding how risk is priced in the market, with beta serving as a crucial measure of systematic risk in investments. This frame delves into the concept of beta and its role in understanding systematic risk. Beta is a numerical measure that indicates how much a stock's price fluctuates in relation to the overall market. It is crucial to note that systematic risk, which affects all stocks, cannot be eliminated through diversification. In contrast, unsystematic risk is unique to individual companies and can be mitigated through a well-diversified portfolio. The chapter categorizes stocks based on their beta values, labeling high beta stocks as aggressive and low beta stocks as defensive. Ultimately, the capital asset pricing model (CAPM) emphasizes that investors are compensated only for bearing systematic risk, reinforcing the importance of beta in investment decisions. In this frame, we introduce the concept of behavioral finance, which serves as a critique of traditional finance theories that assume rational investor behavior. The chapter highlights the contributions of Kahneman and Tversky, who laid the groundwork for this new field. We also outline the four main factors that lead to irrational behavior in investors, emphasizing the importance of recognizing these biases. By understanding these concepts, individual investors can better navigate the complexities of the stock market and make more informed decisions. This frame delves into the key insights derived from behavioral finance. It discusses how overconfidence can lead investors to trade excessively, often resulting in suboptimal returns. The impact of biased judgments on risk assessment is also highlighted, along with the dangers of herd mentality, which can create market bubbles. Loss aversion is another critical concept, explaining why investors may cling to losing stocks. Additionally, we touch on the importance of framing in decision-making. Finally, we suggest strategies to counteract these biases, such as adopting a passive investment approach and being wary of following the crowd. In this introduction, we explore the evolving landscape of investment strategies as traditional stock picking faces skepticism. The chapter highlights a significant shift in investor behavior, moving from actively managed funds to passive index funds. This transition has paved the way for innovative strategies like smart beta and risk parity, which promise enhanced portfolio performance without the burden of additional risk. However, It is crucial for investors to grasp the strengths and weaknesses of these strategies. The chapter poses essential questions regarding the effectiveness of smart beta and the potential risks associated with risk parity, setting the stage for a deeper exploration of these concepts. This frame delves into the concepts of smart beta and risk parity, two innovative strategies that have emerged in the investment landscape. Smart beta seeks to achieve excess returns through passive, rules-based strategies, although its definition remains fluid. The chapter emphasizes the importance of maintaining a core portfolio of low-cost index funds, which historically outperform actively managed funds. Investors are reminded of the substantial risk premium associated with stock market volatility, and the Sharpe ratio is introduced as a key metric for assessing the risk-return trade-off. Finally, the concept of risk parity is presented, highlighting its potential to enhance returns by leveraging low-risk assets, thus providing a comprehensive overview of these modern investment strategies. In this frame, we introduce the chapter titled, A Fitness Manual for Random Walkers and Other Investors. The chapter emphasizes the importance of balancing risk and comfort in investing. It highlights that saving early and regularly is vital for achieving financial security. The power of compound interest is discussed, showcasing how it can significantly grow wealth over time. Additionally, the necessity of maintaining cash reserves and insurance to handle unexpected expenses is stressed. Understanding personal investment objectives and the importance of diversification in reducing risk and enhancing returns are also key takeaways from this chapter. This frame outlines key exercises for successful investing as discussed in the chapter. It emphasizes the importance of starting a regular savings program early to build wealth over time. Maintaining cash reserves is crucial for handling emergencies and unexpected expenses. The chapter encourages investing in tax-advantaged accounts like IRAs and 401(k)s to maximize savings. Understanding the risk levels associated with different investments is essential for making informed decisions. Additionally, utilizing low-cost investment options can significantly enhance returns. Finally, diversification is highlighted as a critical strategy for mitigating risks in an investment portfolio. This introduction sets the stage for the chapter on understanding and projecting returns from stocks and bonds. It highlights the key themes, such as the importance of constructing a winning portfolio and the factors that influence long-run returns. The chapter emphasizes the significance of dividend yield and growth rate, as well as the impact of valuation changes on returns. Additionally, it provides a historical context by analyzing different eras of financial market returns, which helps in understanding the current landscape and projecting future returns. This frame delves into the key determinants of returns from stocks and bonds. It explains that long-run stock returns are primarily driven by the initial dividend yield and the growth rate of earnings. The concept of discounted future dividends is introduced, emphasizing its importance for investors. Additionally, it highlights how short-term returns can be influenced by changes in valuation. The historical context is provided, noting that the average stock return from 1926 to 2018 was around 10%. For bonds, the yield to maturity serves as a good approximation of returns, while inflation is identified as a critical factor affecting bond performance. This slide introduces the key concepts from Chapter 14, which emphasizes the importance of aligning investment strategies with different life stages. It highlights that younger investors, like those in their 30s, can afford to take more risks because they have the potential to recover from losses through their income. In contrast, older investors, particularly those nearing retirement, should focus on stability and income generation. The slide also touches on the significance of asset allocation in maximizing returns and the relationship between risk and return, as well as the benefits of dollar-cost averaging in reducing investment risks. This slide outlines the 5 essential principles of asset allocation discussed in the chapter. It reiterates the fundamental relationship between risk and return, emphasizing that higher potential returns come with increased risk. The holding period of investments is crucial, as longer durations can reduce risk. Dollar-cost averaging is presented as a strategy to mitigate the risks associated with market timing. Rebalancing is highlighted as a technique to maintain desired risk levels and potentially improve returns. Lastly, the slide stresses the importance of understanding one's attitude towards risk and tailoring investments to meet specific financial needs, ensuring a personalized approach to investing. In this chapter, we explore the essential rules for buying stocks and the importance of asset allocation. The author emphasizes three primary methods for purchasing stocks: the no-brainer step, the do-it-yourself step, and the substitute player step. The no-brainer step involves investing in index funds, which are recommended as a core strategy for most investors. The chapter also discusses the role of professional investment managers and how they can assist in navigating the stock market. Finally, specific recommendations for building a diversified portfolio are provided, ensuring that investors can make informed decisions. This section delves into the advantages of using index funds, highlighting their tax efficiency and the importance of international diversification. The author provides a specific index fund portfolio tailored for investors in their mid-50s, emphasizing the need for a balanced approach. The chapter also discusses the rise of automated investment services, which offer low-cost management options for investors. Finally, the author shares final thoughts on effective investing strategies, encouraging readers to adopt a diversified approach while remaining aware of the risks involved. This comprehensive overview aims to equip investors with the knowledge needed to navigate the complexities of the stock market.